Understanding bond prices and yields. It is said everything has a price, right? So what do we mean by price in the bond market? That is exactly what we'll be learning today, prices and yields. But before that, hey, this is Shubham and I welcome you all to our knowledge series by SMEST Discover, where you can get smart about investing. Bond prices refer to the current market value of a bond. This price is determined by several factors, including the current interest rate, the creditworthiness of the issuer, the bond's maturity date, and the coupon rate. Let's see how each of these factors affect the bond's price. So, when the interest rates rise, bond prices typically fall and vice versa. This is because as interest rates increase, the fixed coupon rate of existing bonds become less attractive to the investors compared to the new bonds offering higher interest rates. Next, the creditworthiness of the issuer can also affect the bond prices. Bonds issued by companies with a lower credit rating may be perceived as riskier investments and have lower market price. The maturity date of a bond can also impact its price. This is generally because longer term bonds are more sensitive to changes in interest rates. Long term creates higher uncertainty about future economic conditions, thereby impacting the value of long term bonds more than the short term bonds. Now, let's look at the yield. In simple terms, the yield of a bond is the rate of return that an investor would receive by holding the bond until its maturity. Expressed as an annual percentage rate, it represents the total amount of interest income and gains that an investor would receive over the life of the bond. Now, there are several different types of yields that are commonly used to measure the return on the bond investment. Let's see what they are. First is the coupon. This is the annual interest rate that the bond pays based on its face value. For example, if a bond has a face value of 1000 rupees and pays a coupon rate of 5%, the interest received on the coupon would be 50 rupees per year. This 50 rupees is your coupon yield. Second is the yield to maturity or YTM. Yield to maturity is the total return that an investor would earn if they held the bond until maturity. YTM considers the bond's current market price, the coupon rate, and the time remaining until maturity. And the third is the yield to call. This is the yield that an investor would receive if the bond is called or redeemed by the issuer before its maturity date. It considers the call price, call date, and the time remaining until the call date. Now, just like the price of a bond, the yield of a bond can be affected by a variety of factors. Let's have a look at them one by one. The first factor impacting the yield is the credit rating. A bond with a higher credit rating is generally considered to be less risky and therefore has a lower yield. Second comes the market condition. If the demand for a bond is high, the yield on that bond may be lower and vice versa. Third is the inflation expectations. If investors expect inflation to be high in the future, they may demand a higher yield to compensate for the erosion of purchasing power. Fourth comes the interest rates. If the interest rates rise, the price of the existing bond will fall, resulting in a higher yield, and the opposite happens if the interest rates fall. Fifth comes the default risk. The risk that a bond issuer will default on its payment can also affect the yield. A bond with a higher default risk may have a higher yield to compensate for this risk. Sixth is the maturity. Bonds with longer maturities have higher yields than those with the shorter maturities because they are exposed to the interest rate risk for a longer period of time. And seventh is the tax considerations. The tax treatment of a bond's interest income can also affect its yield. For example, tax-free bonds have lower yield because the interest income is tax-free. Surprised to see how dynamic the yield of a bond is? Let's go ahead and talk further about two other important terms. Number one is the accrued interest. Accrued interest is the interest that has accumulated on a bond since its last coupon date. It represents the interest that the investor has earned for the period of time that they have held the bond. Now let's understand it by a simple example. Now let's say Kotak Mahindra Bank issued a bond on the 1st of January with the interest payment frequency of 1 year. Shweta buys the bond on the same day. Now, Shweta decides to sell the bond after 6 months on the 30th June to Shreya. So, Shreya will have to pay the principal amount plus the accrued interest of 6 months to Shweta. But wait, hold on. Why is Shreya paying any interest to Shweta at all? Well, that's because on 31st December, Kotak will give the full interest to Shreya, even though she bought the bond 6 months after the bond was issued. The price of a bond without the accrued interest is called the clean price, and with accrued interest, it is called the dirty price. So, the settlement amount or the final amount would be the principal amount plus the accrued interest of 6 months plus the stamp duty that Shreya will have to pay to purchase the bond. Easy, isn't it? Now, number two is the day count convention. A day count convention is a standardized methodology for calculating the number of days between two dates. This is done to value a bond accurately. There are four popular day count conventions. Number one, 30 by 360. The 30 by 360 convention is used in the treasury bond markets in many countries. Indian treasury markets also use 30 as the numerator by 360 day count as the denominator convention. Number two, actual by 360. This convention counts the actual number of days in a month in the numerator but uses 360 as the number of days in the year as the denominator. Number 3, actual by actual. This convention uses the actual number of days in the month as the numerator and the actual number of days in a year 365 or 366 as the denominator for a leap year. And number 4 is the actual by 365. This convention uses the actual number of days in a month as the numerator and 365 days as the days in the year as the denominator. Now, learning about the price and yield and the common factors of the dynamics, you must be thinking, is there any relationship between price and yield? Well, there is. The price and yield of a bond are inversely related. So, as the price of a bond goes up, the yield goes down, and as the price of a bond goes down, the yield goes up. When the yield on a bond goes down, it means that the investors are willing to accept a lower return on their investment, which in turn drives up the price of the bond to reflect this lower yield. And it's directly opposite when the yield on the bond goes up, which creates an inverse relationship between price and yield. I hope that you understood about the prices and yield of a bond and the relationship between them. Visit SMEST.in and take the next step towards investing wisely. Stay tuned for many more exciting lessons coming your way. But before signing off, always remember, investments in debt securities are subject to market risks. Read all the offer related documents carefully. For any queries on this module, please leave a comment below. See you in the next video.